Hi everybody, this is Ellman, the blue collar investor, with today's option selling question of the day. Today's question comes from Roni, one of the frequent contributors to our BCI blog. Alan, when our strike is in the money at expiration, why not let the option be assigned and realize our profit? When we roll out or out and up, we lose threefold. We lose on the spread, probably get a debit, and add risk as an appreciated stock can go down soon. Why not let the stock get assigned and buy it back on Monday if we still like the stock? Thanks, and it's signed, Ronnie. Well, as always, Ronnie asks some very good questions, and this is a question that we do have to address frequently to some of our members, so I appreciate the opportunity to respond to it again. So let's start by summarizing rolling concerns. We lose on the spread. Now that's the bid-ask spread. So the difference between the bid price and the ask price. When we sell at the bid, the lower, and when we buy at the ask, the higher. And there is a difference between the two, and that's one area of Ronnie's concern. Probably result in a debit. Now, if the strike is in the money, the premium to buy back that option will consist of both intrinsic value, the amount that the strike is in the money, plus time value. And when you compare that to the option that we're going to sell for the next month, frequently there will be a lower price for the next month's option. But will it in fact represent a debit? And that's something we'll explore. And the third concern was that since the stock has most likely appreciated, and that's why the strike is in the money, there's a greater opportunity for the price of the stock to go down and thereby represent additional risk. So these are the concerns that Ronnie has, and we're going to address them with a stock that was on the premium watch list on the 17th, the Friday before expiration, and or the Friday actually of expiration, and then the weekend prior to the new contract. So if you look at the screenshot here, the stock that I selected to use is JBL, J-A-B-I-L Inc. The ticker symbol is JBL. Now, if you have a look, you'll notice that of the last 4 weeks, JBL has been on our watch list 4 times. So 4 out of 5 is pretty good, considering how difficult it is to get onto our watch list after being screened from a fundamental, technical, and common sense perspective. So we're going to have a look at JBL, and we're going to see how the rolling calculations play out and whether or not it makes any sense to consider rolling as part of our exit strategy arsenal. So here's a potential rolling trade. We're going to go back to the beginning of the January contracts. So on 12/23, JBL could have been purchased at $39.50, and the 40 out of the money strike sold at $1.20. Now that part of the trade is not really relevant to whether or not we should roll at the end of the January contracts, but I just put it there to establish a foundation of how the trade was started. Now, this part is important. January 17th expiration Friday prior to the market closing. The cost to buy back that $40 call option is now $3.30. As you'll see in a moment, the price of the stock had appreciated to $43.23. So if the cost to close is $3.30, of that $3.30, the 40 strike is in the money by $3.23. That's the intrinsic value of the $3.30 premium. The time value is only 7 cents. So the actual time value cost to close is 7 cents, although the entire premium is actually $3.30. So we're going to break down these calculations for you later in this video. Now, to open, to close and then open the next month's 40 call, which is rolling out, will generate 349. So if you look at this, we're going to spend 330 and then we're going to receive 349. That's only for a net credit of 19 cents. And a cost basis of shares that are currently worth $40, that's hardly worth our while. So we're not going to focus in on rolling out. Sometimes rolling out makes a lot of sense, but in this case, the 40 strike is too deep in the money to allow us to get any kind of time value credit here. So we're going to look instead at the 43. Now, the 43, it represents rolling out to the next month and up to the 43 strike, but 43 is still in the money compared to the current market value, as you'll see, of 43.23, slightly in the money, where you're still rolling out and up. So there we're going to receive a premium of 125. Well, you might say initially, well, wait a minute, that's even less than the 40 call. Yes, it is. But when we remove the $40 obligation to sell and we resell the 43, our shares move up in value from 40 to 43. So we'll actually have an unrealized credit of $3 a share. The calculator will break this down in one of the upcoming screenshots. Suffice it to say that when we roll out and up, we're going to be increasing the current value of our shares because we're removing the obligation to sell at a lower price. Okay, so that's the trade. Now, let's address the concerns that Ronnie had in his question. First of all, we're going to lose on the spread, the bid and the ask spread. Well, when we're closing the near month $40 call, and it's almost, if it's on expiration Friday or close to it, most of the money we're going to spend is spent on intrinsic value. That's money that we're going to get back, at least initially, in the form of share appreciation, because we no longer will have an obligation to sell at the lower price. So if we spend $330 to buy to close, we're only spending 7 cents of time value because shares are going to move up in price by the intrinsic value component. Okay, so as far as the spread is concerned, when we buy to close and we only have a few pennies of time value that we're spending, the spread really is not that significant. Now, when we sell to open the next month's strike, in this case, we're going to focus in on the 43, but whatever the strike is, we do have a bid-ask concern. Now, some of that can be mitigated by using options that have adequate liquidity, which is one of the requirements in the BCI methodology. We want to have at least 100 open contracts and or a bid-ask spread of 30 cents or less. So that's the BCI guideline for that. So using options with adequate liquidity will help mitigate some of these bid-ask spread concerns. Also, we have the show or fill rule to also help mitigate the differences between the bid and the ask. And although that's beyond the scope of this particular video, the information on how to negotiate with the market maker, leveraging the show or fill rule, is in both my books and in my DVD programs. So that's how we address the spread. Now, let's address concern number 2, which is resulting in a debit. In other words, the cost to close could be far greater than when we sell to open the new contract the following month. Well, once again, let me go back to what we said before, and that is our concern is only the time value cost to close, because the intrinsic value is going to be compensated for by an unrealized increase in share appreciation. And since there's a greater amount of time to expiration of the next month contract than there is of the near month contract, there'll almost always be a credit, not a debit, on the time value component of the premium. The intrinsic value of the component is negated by the increase in share value, even though it is an unrealized increase in share value. That means that we haven't sold the stock. Okay, concern number 3. Well, the price of the stock has gone up. It could easily go down. Maybe profit taking will bring the price down. Isn't that an additional risk? Well, let's have a look at the price chart of JBL on 117. And here you could see on the top right circled area, the exponential moving averages are extremely bullish. The 20-day EMA, that top line, is above the 100-day EMA, the lower line, and the price bars are at or above the 20-day exponential moving average. So the moving averages are bullish. Now, the middle circle towards the bottom right represents the MACD and the MACD histogram. You can see those are both above zero. So we have a bullish MACD signal. Now the circle on the bottom right represents the stochastic oscillator, which had been bullish for quite a while. It just barely went underneath the 80th percentile all the way on the far right bottom. And so that represents a very minor red flag. So at this point in time, I would consider this chart mixed to slightly bullish. So we ask ourselves this question. Forgetting about the fact that we had this position in our portfolio in the current now expiring month, is this a stock we would consider had we not already owned it, just moving into a brand new trade? And I think the answer generally is, well, if the calculations meet our goals, then yes. Based on this chart pattern, this is a stock that I would definitely consider for this month's portfolio. All right, now, if you have concerns, you can work with an in-the-money strike. But in this particular case, as I said, the chart is mostly bullish. Now, let's actually run the calculations. Once again, the original month we sold the 40 call. The price of the stock is $43.23. So we fill in the what now tab of the Ellman calculator for rolling considerations. And you could see the pricing. The original option was $120. That has no impact on whether or not we should roll our option. And the current cost to close is $330. Now on the bottom right, you could see that the 40 rolling out to the 40 generated $349. We're not going to look at that because the credit is too small. But we will look at the 43 rolling out and up. Now, remember, the price of the stock is $43.23. So even though we're rolling out and up, we're rolling out and up to a still in the money strike, slightly in the money. 43 compared to the 43.23 current market value. So very, very slightly in the money. But yet we are still rolling out to the next month and up from 40 to 43. So that information is entered into the blue cells in the What Now tab of the Ellman calculator. And then the white cells on the right side of the spreadsheet become populated. So if you have a look now where the arrow shows that the time value return for this particular trade is a 1 month return of 2.38%. Now, if that falls into our initial time value return goal range, then this is a trade that we should consider. So rolling out and up from 40 to the 43 strike, generating a 1 month return of 2.38%. If that falls into our range, then we may end up rolling the option. So let's summarize here now. Rolling out and up, or just rolling out, are viable strategies. We want to make sure the stock is still eligible. Now remember, one of the most important things that we need to check when we do roll the option is that there's no earnings report in the following contract month, which there wasn't for JBL. That was one of the first things that I checked before I used this as our example. And of course, the calculations must meet our initial time value return goal range. In my case, it's 2 to 4%, so the 2.38% would definitely fall into an acceptable return in my portfolios. Now, by rolling the option, we're protecting against continued share appreciation when the market opens the following week. Look, the stock is such that the strike expired in the money. The chart pattern looks favorable. So it's not inconceivable that by the time the market opens on Monday, the price of the stock has gone up even higher. Maybe it went from 43.23 and opened at 45. Whatever. By rolling the option, we're guaranteed to have that particular security at our current cost basis. So that's one of the advantages. Now, of course, the price of the stock could go down. But when we're looking to throw the odds in our favor, which is more likely to occur? An appreciating stock still appreciating in value with no particular news coming out, or the price of the stock turning around and going the other direction. So we don't know for sure, but what I always say is if the deal is there, take it. In this particular case, we have an opportunity for a 2.38% 1 month return. If that meets our goal, the deal is there, then we should consider taking it by rolling the option. If we're not sure, based on the technical chart, based on the returns, any concern at all, if we're not sure, then do nothing. Allow the option to expire and therefore get your shares sold at the strike price. Then on Monday or Tuesday of the following week, when the new contracts begin, then you could make your determinations. Finally, I just want to remind all of our premium members that all Ask Alan videos, the entire library, is available only to our premium members. And this was Ask Alan video number 172. We also add a new video to our library every month. So only our premium members can access the entire library. Just log into the member site, scroll down on the left side where you see the Ask Alan where the arrow is, and then you'll see the first 10 that I made. Many moons ago, you'll see the technology wasn't as good then as it is today. And then if you click on the link below those, you'll open up the opportunity to view any of the other 162 Ask Alan videos. And again, we'll add a new one for you every month. So Roni, let me just say this once again, a brilliant question. Thank you so much for that. And of course, I want to thank everybody out there for taking the time to watch this video. I hope you enjoyed it, and most importantly, I hope you make some money from it. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.